So just before we start, Alex, is it worth running over how the last quarter and the last year shaped up for investors?
Yeah, thanks, Stuart, and thanks for having me on today. It's like you say, there's a fair bit to cover today, I think, with, as you said, a new government, a budget which is, I'd say, causing a lot of instability and concern from investors, which we can cover off. You've got conflict in the Middle East, which is pushing up the oil price, and what's the impact that have on inflation? We've been here, we've seen it before. So yeah, please do feel free to ask any questions during this. But just back to what you, the original question, Stuart, what's been happening in markets? Well, it was quite a strong quarter for investment markets. So this looks at from the end of June to the end of September. You've got government bonds in that blue line, corporate bonds in the maroon, strategic bonds, which we buy in yellow, and emerging market debt in green. And you can see there that you've got positive return from all asset classes across the board. That's because we're now in a world where interest rates are coming down. Bond markets were really hammered in 2022 as inflation was high and interest rates were increasing. We're now seeing a reverse of that to a certain extent. As interest rates come down, it means that bond yields should come down as well. So something very important to be aware of. In terms of equity markets, you can see here on the right hand side the S&P 500 in blue, slight negative return. Our very own FTSE All Share in maroon, not a bad return of 2% during the quarter, and similar for Japan. But the real standout market there is the bottom one, which is Hang Seng, which is the Hong Kong stock market. And you can see that it really spiked towards the end of the quarter. That was driven by a number of measures by the Chinese central bank and Chinese government to stimulate the economy. China has been going through a real estate crisis now for probably 3 or 4 years, and it's really been impacting sentiment in China, and it's really been impacting growth within China. And the measures that they've done to cut interest rates, to cut deposits needed to buy second houses. They've also introduced a package to directly buy the equity market, has really stimulated the market, and it's up about 25% in 2 weeks. It's been one hell of a rally. You can see it on that chart. What I would say, though, is China's not without risk. It was down 8% last night. It's an incredibly volatile market, and we do have some concerns about corporate governance there. And if you just zoom out and look at a slightly longer period, it has been a pretty strong period for markets over the last year. The rally in stock markets really started a year ago. A year ago, we had 7% inflation. Nobody thought interest rates were coming down, and there was the expectation that we were going into recession. You fast forward, and inflation's back down to the Bank of England target. Interest rates are coming down, and the UK economy is actually performing pretty strongly, as is the global economy. So markets on the whole have delivered pretty decent returns over the last year. US has led the way, up 24% in a year, pretty stellar growth. Japan has been a bit more volatile. It's that yellow line, but it's still delivered good returns of 15%, similar to the UK. And you can really see that how strong that rally's been in the Hang Seng as you look at the end of that chart. Chinese assets have been depressed for a long period of time, and it's really closed that gap. And then just zooming out and looking at the bond market, you've been able to deliver an 8% return from a government bond portfolio and a 10% return from a fixed income portfolio over the last year. So that's equity-like returns from bonds. So it's been a decent quarter, a bit more volatility, policy stimulus being announced, which has supported Chinese assets. But it's really been built on the foundations of what's been a very strong year from the end of September last year to the end of September this year.
Great, thanks, Alex. I mean, one thing we did discuss in the last quarterly meeting was the UK perhaps being perceived now as being a safe place for investing. Yeah. So how would you say the UK has performed? I mean, I know you've got the FTSE 100, primarily large mega cap funds, which might not be representative of what's going on the high street. So how would you say that the UK market has performed?
Well, I mean, if you go back to the FTSE 100 there, it is slightly lagged over the last year versus the S&P, and the real driver in the US market over the last 2 years really has been about artificial intelligence and technology, and the earnings growth that those businesses are going through, Nvidia primarily, has been significant. And what the makeup of the UK stock market is, it's more banks, oil companies, health companies, Glaxo and AstraZeneca, and mining companies to a certain extent. Just a generalisation, they're the main sectors within the FTSE. So it doesn't have a big technology presence. So it has lagged because of that. That being said, we're still pretty optimistic about the UK stock market in terms of the valuation we are today, and maybe we'll touch on it later. Some of the things that we're seeing at the moment that we think are really interesting and drivers that the UK market is cheap, and people are looking to take advantage of that.
Okay, good. Now, the big white elephant in the room, then everyone's asking, know all the advisors who may be listening in to this will have been getting phone calls left, right, and centre. The up and coming budget, crystal ball time, Alex. Is there anything that you can give any insight to what maybe listeners can expect, or give any thoughts? I know there was a recent announcement with regards to Labour not limiting the amount of tax relief you can get on pension contributions.
Yeah, I think let's highlight the problem. The problem is the black hole, the 22 billion black hole that's in the public finances that they've come forward and announced. I don't know how much of that is actually accurate, but there we go. So you're getting kind of a glimpse into some of the stuff we're going to talk about later. But this is the problem. So this chart goes back to 1955. You've got spending in the purple line, and you've got tax revenue in the grey line. And you can see that spending has been significantly above revenue as a percentage of GDP. That's what the axis is for nearly 60, 70 years. And that means that we've amassed debt. So we've gone through 100% of debt to GDP now, which is the highest level of debt that we've had outside of wartime. World War I and World War II. So we're at a level of debt now which has not been seen for a very long period of time. And the issue is that grey line's been going up, tax revenue's been going up. They froze the wage bands for a number of years now, which has kind of been a hidden tax as well. As our wages been going up, we've all slowly been spending a little bit more, and that's why that line's been going up. It was quite a clever, tricky move that no one really noticed. But spending's been going up as well. There's an issue within the UK. There's been an issue within the UK that we've got an aging population. So as you get an aging population, you spend more money on healthcare via the NHS. And there's a roughly 7% of the workforce in the UK which are currently off long-term sick, and you have to pay for them as well. So that's having an impact. So that's why spending's going up. So what do the government do? Because they clearly need to increase tax, but we're at the highest percentage of tax that we pay for a long period of time. And in the manifesto, if that's anything to go by, they promised to freeze the 4 big taxes, which is income tax, national insurance, VAT, and corporation tax. They make up 75% of the tax take in the UK. So that's why they're looking for the smaller taxes to be able to try and make an impact. And what I mean by them are impacting pensions, inheritance tax, CGT, and maybe something like fuel duty as well might increase, which might not be a bad time to be doing it with the oil price. We'll touch on that later. Being relatively low, it's not near the highs that it was 2 or 3 years ago when Russia invaded the Ukraine. The honest answer is I don't know what's going to happen. I wish I did. I'd be surprised if they touch any of the 4 big taxes, but as I said, because that was in their manifesto, but they probably need to do something. And I do think you'll see changes. The issue being, though, that let's take capital gains tax. So you're seeing at the moment if investors being worried about increasing capital gains tax, and therefore we have seen a few clients that have said, well, let's take gains this year before the tax rate goes up. the other point to make on that is you don't know when the rate's going to increase. Is that going to be overnight, or is that going to be increasing the new tax year? And the other point that's made is increasing taxes can actually lower your tax revenue as well. And it's not really something ever talks about. But if you increase capital gains tax to be in line with income tax, then people will stop crystallising gains. So then you just stop seeing lower tax revenues. And when you increased salary levels, then you saw people leave the UK because the tax take was too much. So it all sounds well and good on a spreadsheet, but the real world impact is people's behaviour change, and you can't judge that. So I think it's a very, very difficult budget. They clearly need to do something. But even if what has been announced might, or been proposed to be announced, might not actually have the impact that they desire to have.
And I think we saw that with Rachel Reeves in the Office for National Statistics when they were talking about reducing the tax breaks on VCTs and private equity and the EIS, and they said actually it will actually decrease the revenue coming in if you start to do that.
Yeah, no, absolutely. And I think Labour's policy at the moment seems to be leak stuff to the press, see what the public feedback is, and then roll back on it a little bit. And the Prime Minister's come forward and Rachel Reeves has come forward and been very strong and said this is going to be a very tough budget. But what I expect they'll do is they'll go say it's going to be a tough budget and roll back. So there's a little bit of feel-good factor that comes through as well. So we'll see. We've got 3 weeks to go until it's all announced. We're analysing it and trying to keep on top of it as much as possible, but it's difficult to, as I say, because you're not sure what's going to be announced and when it's going to be imposed by.
Okay. So not much good news, by the sounds of it.
Well, it's definitely impacted, and that's a sad thing, I think, as well, in that after the election and when we were talking last time, there was definitely a bit of feel-good factor about the UK again that had been missing for a long period of time. And it feels like this budget's overshadowed that to a certain extent, and it's really impacted consumer sentiment and business sentiment, which necessarily didn't have to have done. And maybe it's about bringing out all your dead bodies early on in their owners, their time in office, but who knows?
Okay, good. I mean, I would just put a wee caveat for any listeners out there. If you do have any concerns about your investments, about the impending changes in the budget, please feel free to speak to your advisor and talk through any concerns that you have and worries, and there may be things that we can do, but generally I wouldn't second guess what is planned, and it's very much let's wait and see and then let's react to actually what's happened as opposed to second guessing them. But if there are any concerns out there, please feel free to speak to your advisor. So can we get on to some good news, Alex?
Just before we move on, the only thing I'd add as well on that is if there are going to be changes to capital gains tax, it just means make sure that you're maximising all of your allowances. Make sure that you've got the right buckets in place. Speak to your financial advisor and make sure that that's all in. The easy bits are done, and make sure that you're allocating appropriately. This is the time to get your ducks in a row.
Yeah, and there's not long left, as you said, only 3 weeks. So just moving on to some good news, if we can. We are seeing inflation falling. You've already mentioned it.
Yeah.
We're seeing interest rates coming down. I think it was Alliance and Leicester had a 5-year fixed rate at 3.65, if I remember rightly, at the back end of last week. So the interest rates inflation seems to be moving down. On the negative side of that, there will be an impact upon people for the last couple of years who have been getting 5-6% in cash, seeing what the returns on cash rates they'll be getting coming down. So is it worth just touching on, are there any more interest rates coming? Do you perceive, do you expect, what do you expect with inflation? Is it as low as it's going to be?
Yeah, sure. Just give me a second, I'll just share some slides on this as well then. Go back to some I made earlier.
One you prepared earlier.
They're in here somewhere. Where are we? US and play UK. Here we are. Next slide. UK inflation. So let's start with inflation. You're right, inflation's back down to 2.2%. So the Bank of England target's 2, so we're bang in line with that. You can see the roller coaster ride we went through after Russia invaded the Ukraine. The blue section in here is service inflation. I think that's starting to cause the Bank of England some worries because it's a bit sticky and it's not coming down as fast as other areas like food and alcohol and consumer goods, etc. So that's a positive in terms of inflation being down, but that services, that blue bit that makes up inflation is probably a bit too high for their liking. You can see the bars below zero, they're deflationary. That's electricity and gas and liquid fuels. Now, electricity and gas, that's going to stop being a negative because energy prices this year are going to be slightly higher than they were last year. So that's going to disappear soon. So that means that orange line is going to move up a little bit as that kind of drops out the figures. The latest developments on the oil price as well, it's increased from $70 to $80, but it's nowhere near the $130 it was when Russia invaded the Ukraine. So I can't really see fuels being a big driver, despite the pickup in the oil price at the moment. If things do escalate even further, which they are doing at a very quick rate, then that's definitely something to watch out on. I think service inflation will come down. So all in all, the next few months, we'd probably expect inflation to tick up a little bit, maybe to kind of 3%-ish again, but it's not going down. It's not going up to the levels that we saw, a couple of years ago. What does that mean? As you said, we had 14 months of interest rates going up from 2021 to 2022. It was one of the steepest increase in interest rates that we've ever seen. The 25. I was on holiday actually. This is how sad I am. I was on sat on the sun lounges listening to the Bank of England cut interest rates because it was a monumental moment. But that was at the beginning of August, so interest rates have come down. The expectation is that you'll get another interest rate cut in November. So despite the fact inflation is going to be picking up a little bit, you'll likely see another interest rate cut in November, probably another 25 basis points. But where do they end up? What we're speaking to and hearing from economists at the moment is that kind of 3.5 seems to be the level that the new normal. So we'll never go back to the levels that we got to since the financial crisis when they were basically zero. I think they've realised that was a massive policy error now. But maybe around 3.5 seems to be an appropriate level, which is sensible. Money should cost and have a value. It shouldn't be free, and that's to us is still pretty attractive. So when we're looking forward, that means that you can still make pretty good returns from bond markets. It means that companies aren't having to pay significant amount. Oh gosh, I'm in the dark. Can't believe that's happened. Sorry, just stand up.
You need to start moving.
No, this time that's never happened in a presentation before. Completely blacking out. So if I have to stand up every 10 minutes now, you know why.
It was like the Great Depression, that when all the electricity went out.
Exactly, yeah. So yeah, we're at 5% and we're going to go to 3.5. The market's pricing in one cut a quarter, so that kind of takes you 18 months or so away to where we get to the natural level. Nothing's ever that simple though. Markets might be a little bit hot, inflation might be a little bit hotter, which might delay stuff, but that's sort of where we're getting to in terms of interest rates, and that's been important. And you mentioned mortgage rates. Mortgage rates has been a big impact on the economy as we've been going to higher rates and people are coming off longer fixed rates and going on to new higher rates. That's been having a big impact on disposable income. And over the last few months, you started to see house prices tick up quite nicely. So Halifax had data out yesterday, which showed that house prices are in a whisker of all-time highs again. And that's important because houses are our major asset that we have in our investment portfolios. So as individuals, so that's definitely a positive that you're seeing. Interest rates coming down, house prices going up. But as you said, you can't have your cake and eat it. We've been fortunate to be able to put money in the bank and have a decent return over the last year or so, and that is looking like it's going to start to come to an end. You still get an okay return, but it's not going to be the returns that you were getting a year or two ago.
Okay. And I think it's safe to say inflation necessarily isn't a bad thing. A little bit of inflation is good because it keeps the economy moving. We're seeing wage inflation coming under control, so we're
Yeah.
not getting these spiraling people, the employees insisting on 10% increase in salaries. And I think you mentioned it before, Alex, my daughter, she's 28, she's got a mortgage, and she's saying, Dad, how expensive are mortgages? And I'm going, well, darling, they're not that expensive. It's just since 2008 in the financial crisis, we had an extended period, which was not the norm, but was
Yeah.
perceived to be the norm. And it should be, the norm should be around 3.5% in terms of interest rates, 4%, 3.5 to 5%. Would you agree?
Yeah, I think that seems a sensible level. It means cash depositors are getting an okay return, but it
Yeah.
also means that the cost of debt isn't too high as well, and it seems to be normal. It's above inflation. We've had a period where interest rates were below inflation. So in real terms, investors were losing out. So at least this time you're going to get a real return from cash as well above inflation. So yeah, I
Alex,
think.
can I just touch on something? Because I had a client and they were looking at one of the cash deposit accounts and she was getting 6%, with just down to 5. That's on a 12-month fixed, about to mature.
Hmm.
And she's looking around, she'll probably get around 4.5, 4.6. But I've been discussing looking at a gilt portfolio, and I know gilt rates have come down slightly, but this, with the tax advantages, it's just worth touching on that if people do have cash coming up, it might just be worth an option looking at gilt rates to see if you can get a better return. Because obviously with interest, you're going to be paying income tax.
Yeah, good time to share my favorite slide. Here you go. So as Stuart touched on, these are government bonds in the UK. So on the left hand side, you've just got the name. You've got the maturity date in the next column. You can see there's a variety out there. The one at the top maturing in January 2025. You can see the coupons. The coupons are all pretty low. So that's a bit like a bank account, like you were saying, what you expect to receive as income every year. The reason they're all really low is because they were all issued when interest rates were basically 0 or 0.1 or 0.25. So the coupons on all those bonds were issued very low. Now, all of these government bonds are traded in the market and they're traded until that maturity date. So the coupon doesn't change, but as interest rates have gone up, something has had to change. And what that something is the price. You see that price column, you've got 98.72 at the top down to 87.64 at the bottom. Now, what happens with a government bond is it's issued at 100 and it matures at 100. And as Stuart touched on, that price going back to 100 currently, and this might be something that changes in 3 weeks' time, I don't know, but currently you don't have to pay capital gains tax on that. Buying government bonds is one of the only assets where you don't have to pay capital gains tax in a general investment account. Clearly, if it's in an ISA and a pension, you're in a tax-sheltered environment there. And then, so the return that you're going to get from these government bonds is twofold. You're going to get a bit of coupon, but it's not going to be a lot because the coupons are so small, and you're going to get a bit of the price recovering, which is mostly tax-free. So what we've done then is we've combined those two returns to create this gross redemption yield. So it looks at what the return is per annum. So basically it's 3.9% at the moment. But as we touched on, and as you mentioned there, Stuart, if it's been if you're a higher rate taxpayer and you've got money in the bank, then you are taxed at your marginal tax rate. Whereas these, because it's capital gains tax free in terms of the price recovering to 100, then there's some slight tax benefits to doing this. And if you go all the way to the right hand column, you can see that the overall portfolio here is 5.7, but there's some individual gilts there that you could buy, which you're getting a gross redemption yield of 6 because of the tax benefits of holding them. So and we have a portfolio of them. You can buy individual gilts. They as I said, they're probably they are the most liquid investment in the UK. You buy them today, you can sell them tomorrow. They settle on a T+1 basis. And it's up to each individual. We've got some clients where they have a tax bill coming up and they want to buy a specific gilt with a maturity, knowing that they're going to get the money for that date. They're probably one of the safest investments that you can get. So I suppose if you've got money in the bank, you've got the risk that the bank is going to default, and we're not in a financial crisis, and we don't think that's going to happen. And you're protected by the 85,000 by the Financial Services Compensation Scheme as well. But with gilts, you're borrowing money from the government, you're lending the government money. And that's a very safe thing to do. I mean, if the UK government, which has never defaulted, did default, I think we'd be in a very strange situation. So they're very safe. They're extremely liquid. There's tax benefits that are there. I mean, if we did this a year ago, you were getting a slightly higher return because interest rates were higher then, and it was the expectation that they would never come down. Today, that there is the expectation interest rates have come down and will continue to come down. So not as attractive as a year ago, but certainly still pretty attractive. And as you said, we are buying these every single day at the moment for clients because of the tax benefits. I never thought in my career when I started, and interest rates have been low for such a long period of time, that we'd be talking so much about gilts. But every portfolio, every asset has a place in the portfolio, and for low risk clients or very cautious clients, that really solves a problem for them.
Good. Well, thank you. So I think it's safe to say the UK currently at the moment is sitting in quite a nice position. Let's wait to see what happens in 3 weeks. Obviously, the two biggest economies are the US and China. So if we can just briefly discuss those, I'm conscious of time. But the US election is due to be held on the 5th of November. In terms of not personal views, but your views and outcome on the impact it may have on the markets, whether Kamala or Trump will get in.
Yeah, no, you're absolutely right. We're 4 weeks away now from the election, and it's one of the big things that the market's focusing on in the short term. Gosh, sorry, get to it. Here we go. So this is updated as the end of September. And I forgot actually that when we did the last quarterly call, it was still Biden who was in the presidential candidate. So there has been a change over the last quarter, and you can see what the odds are at the moment. So this is from Real Clear Politics, and it's basically betting odds. So just looking at the betting odds, and you can see there it's very close to call. I was on a US election call yesterday, and it was focusing in on one of the states, and it was in 0.2%, one of the swing states, I think it's Pennsylvania, between the two, and Harris is slightly ahead. If you look at the betting markets, it suggests that Harris is slightly ahead. The polls are suggesting that Harris is slightly ahead. And it's very rare that you get all of those things pointing to that direction and then it doesn't actually happen. So at the moment, I would say there's a slight chance that Harris comes in, which I think the market would prefer, just because of the volatility and potential risks that Trump brings with him. But I suppose the other point to look at is, what's the impact of different governments been on the market and also the economy. So this goes back to 1947. You can see the different parties coming into office and a divided government. And is the economy expanding or contracting on any particular year? You can see that you have contractions or expansions in both parties, because what's going on with the economy is really not really too dependent on what's going on in the White House. For example, 2020 was always going to be a tough year with COVID. It didn't really matter who was present to a certain extent. The financial crisis didn't really matter who was in office. It was being driven by the banking system failing. And that's played out within the market as well. You can have bull markets and bear markets with both parties being in office. I think the other thing to mention on Trump as well is, even during Trump's term, you saw two different types of policy stance. The first being very pro-growth, very pro-stimulus to the US economy, and the market did very well in that environment. But then you saw the aggressive side in terms of trade war with China, and that really impacted global trade and the global economy, and stock markets were very weak in 2019. What we've done is we work with a number of companies that provide us research. This is from Ned Davis Research, NDR. And what they've done is, because the presidential election is every 4 years, they've just overlaid the market every 4 years and put it on top of each other so you can see what's going on. And we're in this grey bar at the moment. This is the election year. And you can see here that every year it's a bit of uncertain. Well, not every year. The average, this is the average year. You see a bit of weakness before the election, but markets tend to do slightly better after the election. And that's because you've got certainty. Markets like certainty of the event. And then you got the first presidential year, which tends to be a relatively strong period for markets, but the second presidential year tends to be a little bit weaker historically. So that's just what history has taught us. It doesn't necessarily mean it will happen this time. I suspect that you will see a bit of a recovery in markets if Harris is elected president, and a mixed reaction if Trump has come through. But again, we can't plan for these things, and you can't position for them because it is so close to call. If you go back to 2016 and the Brexit referendum, there was people fear-mongering that the FTSE 100 would end the year at 5,000 and fall in 20-25%. That didn't happen. It was sterling that got clattered, which was a positive for the FTSE 100 because it meant overseas earnings went up, and the FTSE 100 actually went up during the year. So you've got to be very mindful about positioning for these things and just focusing on the longer term, because we go through political change regularly, and markets take it in their stride. And what's happening with companies is, very not dependent on who's in office within the US or the UK.
Okay. So obviously, America, the old saying goes that if America's sneezes, we all get a cold. That's less so now with China, and you've already mentioned what's happened with China over the last couple of weeks. In terms of the way the equity market, the Hang Seng, has bounced back in the last couple of weeks, just touch on the reasons for that, what the implications might be for clients' underlying investments. Yeah,
so China has been struggling. It's a bit similar to where we were in 2002, 2007, 2008. It's had a housing market problem, which then impacted the banking system. So the banking system has not been lending enough assets out. People haven't wanted to be buying houses. So it's really impacted the economy. And the Chinese economy over the last 20, 30 years has been built on infrastructure spending. So they really need a good, strong housing market. And over in China, 90% of assets aren't in the stock market, they're in property. Property is the big asset. So if property is weak, then it impacts investor sentiment, and investor sentiment's been very weak. And Chinese economic growth has been stalling on the back of that. And that has an impact because China is also a really big retail consumer for Western brands as well. So you've been seeing anything related to China. LVMH, Burberry, for example, have really been struggling more recently because of the Chinese sales are starting to come under pressure. Now, so the measures that they've announced to cut interest rates, to cut deposits that are needed for second homes, the stimulus measures to buy the equity market as well has been very driven to try and support the market and get a bit more some confidence back into the system. I think but it's still too early to say if it's coming through and it's having an impact just yet. The property market can take a long time to correct and work its way through the system because of the liquidity of the asset class. It takes a while to sell properties, so it's to be seen. The other big risk, though, is because China's been slowing, and China's been focusing on new technology, so electric vehicles, and that's having unintended consequences on Europe. So European growth has been really weak this year, Germany in particular, because of what's been going in the auto industry. So that's why you've been seeing them slapped with tariffs, just because they're trying to support their own economy. But we'll wait and see. There's some of the numbers that we're expecting in terms of the adoption of Chinese electric vehicles is pretty significant. I mean, they're about 2 or 3% of market share at the moment, but it's expected to increase to 25% just because the government are giving so many subsidies that they're able to produce these cars so much cheaper than we can in the Western world. So there's bad bits about China, like the property market, but they are being very entrepreneurial, and in terms of what they're doing within the electric vehicle market, which could help support the economy. But that has unintended consequences on developed markets, because that's been our bread and butter for 70 or 80 years.
Yeah, I mean, and people used to think what China made was of poor quality and cheap. That necessarily isn't the case, particularly within the EV market, isn't it?
The honest answer is I don't know, because I've not driven one, and I don't think they've been on the market long enough to be able to get some decent reviews and been tested in terms. I mean, the main thing is the battery life. This is also new now. We need to see how long these batteries are going to last, not just mileage, but how long they can keep going for. And I think it's still very early on in that regard at the moment. But when you've got Teslas, which are costing a fortune, and you've got cheaper vehicles coming through, and Western governments want you to go from to electric vehicles, then you need a low cost option, and that's where the mass market's going to be.
Okay. Okay, thanks for that. Just moving on, we mentioned some of the geopolitical factors that are having an impact on markets, such as still got Ukraine and Russia. We've seen the impact in the Middle East, but perhaps Iran taking a more involved role. And I think people still, the clients that I'm talking to, are still concerned about the impact that some of these geopolitical factors may have upon their investments. So is it worth just touching on what you think the potential impact could be?
Yeah, I mean, the first thing to say is these are horrible situations to be in. The humanitarian loss has been horrendous globally over the last few years. It's really sad to see that this is happening. And what happens when stuff like this comes along is that commodity prices spike. We saw that in Russia, Ukraine with the oil price, but also the natural gas market as well, because Russia was such a big producer of natural gas. The concern now is the oil market because of Iran's oil fields, and it produces about 1.5 million barrels of oil a day, and the growing tensions there between Israel and Iran, and bombing across the borders, etc., really does present some risks there. And I think it's been interesting. You've seen Joe Biden come out and talk directly on that as well. So that's the risk, that you get an oil price increasing. As I said, the oil price increasing, it added about 1% to inflation when Russia invaded Ukraine. So it will have an impact. It won't have a big impact as energy did. Energy is significantly more important from an inflation basket perspective. But that's the concern, that you get inflation higher and interest rates stay higher for longer and don't come down maybe quicker. What does that mean from an investment perspective? Well, two of the biggest oil companies in the world are listed on the FTSE 100, so their share prices have actually been going up the last few days. So BP and Shell are doing better from a financial perspective, which is not what you want to see. You don't want to see people benefiting from human loss. It means that bond markets maybe come under a little pressure, but maybe not to the extent that you saw in 2022. But all in all, direct exposure to the Middle East within UK companies or investing in companies based there is very, very low. I mean, less than 0.01%. We've got very little direct exposure. The only exposure that we will have is indirect, which are companies linked to commodities. And at the moment, as I said, they're actually weirdly benefiting from this situation.
And I think, without sounding Machiavellian, and I don't mean to sound horrible, but with volatility comes opportunity. So,
Absolutely, because at some point in the future, then these conflicts will end, hopefully, for everyone's sake. And when that comes, these uncertainties go away and markets recover. We've seen it so many times over the years, and yeah, at the moment there is definitely a little bit of fear within the market that these things are going on. But if that was fear were to go away, like I said, you have certainty, then that presents the opportunity. So yeah, it has historically been a good time to buy markets when you get periods of volatility like this.
okay. And are there any other opportunities in the markets that that you've been discussing that you're thinking about?
Yeah, I mean, I want to touch on the UK because I think it's relevant. So I'm just going to share a few slides on the UK. So the UK equity market has been cheap for a long period of time. Just needs to find the right slide now. If you look in here, this shows the range that equity valuations have been in since 1990, the grey bar. The average is the green line since 1990, and the blue diamond is where we are today. So if you're buying something with the blue diamond towards the bottom end of that chart, it means you're buying something that's cheap. And one of the best things to do when you're buying markets is to buy cheap and hold for the long term. And you can see there that the UK is undoubtedly cheap. And what happens when valuations are cheap is you see both companies and externals starting to take advantage of that. So what this looks at is the dividend in the UK. So the dividend yield, the UK has always been a high dividend paying market. You're getting nearly 4% from dividends within the UK at the moment. But what you're seeing on top of that is companies realising that their shares are cheap and buying back their shares. So BP and Shell, for example, with oil price being high over the last few years, they've just been buying back their shares, which means there's less shares in the market, which means the share price goes up because there's the supply demand imbalance. And at the moment, you're getting a 6% return in the UK from just both dividends and shares being retired. So that's pretty positive when you think that equity markets should deliver 8% returns over the long term. But if companies are seeing that their share prices are cheap and looking to take advantage of it, other people are as well. So there's been a raft of M&A activity over the last year in the UK market. We've had a couple of these companies and benefited from it. So typically when a company's bought out, it's bought out at a significant premium to where the share price is. Now, Hotel Chocolat, the bottom right there, Mars came in and offered them 170% premium in terms of the share price. So let's put it in numbers, if the shares were trading about £100, they were bought at 270. So it's incredible some of the premiums that are on offer, and we had that within our AIM portfolio. We can touch on AIM in a bit maybe later. But so these are some that have been actually gone through. I thought Rightmove was interesting in that it didn't go through. So Rightmove was approached by REA Group, which is Rupert Murdoch's firm, 4 times, and Rightmove board voted all 4 times that the offer didn't represent good value for shareholders. So they really stood up to them and felt, we want to get our share price up, but we want to do it in the right way. And every single day that we come into the office at the moment, we're seeing a new deal on the screen. So we saw a couple last week. So Mike Ashley, who owns Frasers, obviously formerly of Newcastle United, put a bid in for Mulberry. So that was another interesting bid that went through. So there's things like this that happen all the time. The UK market's cheap. Companies are seeing that, they're buying back their shares, and if they're not being proactive, then you're seeing external private equity or other businesses coming in and taking these businesses out because they're just seeing them as attractive opportunities. And the other weird phenomenon that we're seeing is that you're getting UK businesses that have decided to list in the US. I mean, why wouldn't you? If you've got a company's boards, a company management, their job is to get share prices higher, effectively primarily by increasing the amount of sales and then therefore getting higher turnover. But if you can list in the UK and you're on 10 times, but you list in the US and you're on 15 or 20 times, it's a very quick way of getting your share price up. It makes absolutely no sense because the business is still the exact same business. It's just moving the listing to a different market. That's why ARM decided to list in the US, because it's a technology chip business and not in the UK. They felt they could get a better valuation by listing the business there. And Shell's mentioned that in the past. I don't think they will, because it's been listed in the UK for a long period of time. CRH, the cement business, actually has moved now. Flutter, the gambling group, have moved to the US. Again, not changing the business model, just feel that they can get the share price higher by doing that, which suggests that there's something that needs to be fixed in the UK to get valuations higher.
I think the M&A market that's also reflective of our clients as well, who are looking at selling. So for any of the accountants, corporate finance companies listening at the moment, we're seeing that there's a lot of mergers and acquisition with companies, family-owned businesses, in and around that area. So Alex, thank you. I'm conscious of time. Thank you for your insights today on what's happened within the markets and the impact it may have on clients' assets. There's a couple of questions that have come in. One on sustainability and ESG with regards to what role do we see ESG? It was quite big pre-COVID. There was a lot of discussion about ESG and this mass movement towards ethical funds. That seems to have died down a little bit. So what role do you see ESG playing in long-term investment strategies?
Good question, that. So you could go back to 2020. You're absolutely right. Everyone was talking about ESG investing because you could have your cake and you could eat it. You could invest. You could do so in a really nice way that doesn't harm anyone, and the historic returns had been very strong. So everyone was very positive about ESG on the back of that. You fast forward 4 years, the performance of these funds has now been disappointing, and no one wants to invest there. So these things are cyclical. There's definitely a place for ESG investing. We buy ESG funds within our non-ESG portfolios. I've gone dark again. You have to stand up and wave around again. Apologies. It's quite a cool trick, that, isn't it? Make sure that everyone's still paying attention. So yeah, we buy ESG funds within our non-ESG portfolios because to us, if they can deliver good returns, it doesn't matter what the strategy is. And so we think that there's definitely managers out there that can deliver good returns, but doing it in a sustainable way. Look, this is not going away. The regulators have been increasing the amount of regulation over the last few years. So every time a company reports now, they have to have an ESG report with them. And it's important. I mean, look, we should be looking after our environment. We should be having good governance practices. We should be more sustainable in the way that we work and live. And we've got a climate problem which needs to be addressed. So it's definitely for the benefit. That means that there's going to be more investment into these type of businesses over the coming years as we try and hit our climate target goals. So that where there's money, there's an opportunity. But it just got a bit overhyped. Like certain things do. You go back to the tech bubble, things were overhyped there. In 2020, ESG was a little bit overhyped, but that's definitely come off over the last few years. And to us, there's opportunities to buy good quality products which can deliver good returns and doing so in a sustainable manner.
Good, thank you. Another question that's come in is around how do you manage risk? So you've spoke about some geopolitical factors, the budget, the perception of the UK being very positive, and maybe that's been dampened down a wee bit. China having volatility. So what measures are Luna putting in place to mitigate potential downturns in the market?
Yeah, so I mean, the first one is diversification. So we're not just invested in the equity market. If you're a medium risk investor at Luna, you diversified across a number of different asset classes. So bonds, cash, alternatives, and the equity market. Within the equity market, we're diversified globally. So we've got exposure to the UK, US, Asia, emerging markets, etc. We tend to have bigger exposure to the more developed markets because they're less volatile. So we haven't had a lot in China, which has been to the benefit of portfolios the last 4 years, and maybe not for the benefit of portfolios the last 4 minutes. But that's certainly something that we're thinking about. We also diversify across different managers. So if you looked at a Luna portfolio, there's 20 or 30 different companies within that, different fund management groups, because we don't want to just be wedded to any one particular style. Again, if you're going back to 2020, everyone was talking about growth stocks and technology, and they save the world. You get to November 2020 when they announced the vaccine, everyone's then wants to get back to normal. So it's important that you're just not invested in one type of style and you're thinking about both sides. But we also do lots of scenario analysis. What could happen to our portfolios if there was an oil crisis, if there was another pandemic, etc., or there was a technology market crash, to really assess where our portfolios could perform in that environment. So there's lots of tools that we can do, and the other important part is we're active. We meet as an investment committee on a monthly basis to assess where we think we are within the economic cycle, what's going to happen, and what's going to drive returns. And over the last year, God, there's probably about 30 or 40 things that I can think of that we've done within portfolios because of things changing. But, more recently, interest rates. So we added interest rate risk in June because we were expecting interest rates to come down. And that's benefited portfolios, as we showed earlier on. It's been quite a strong quarter for bond portfolios. But as we got to the end of that quarter, a lot of that had been priced in. So we're always moving things around based on where the market is and how things have changed.
And I think for any listeners, any clients out there who have investments with yourselves or with ourselves and other investment managers, or any partners that have any clients, I would reiterate the importance of having regular reviews. Review your risk, review your volatility. Don't let short-term volatility affect your long-term plans. Don't be reactive. We mentioned it before, Alex, about within volatility, it provides an opportunity, and let the investment managers do what they do best.
Yeah, absolutely. And if case in point, a year ago, it felt pretty horrible. You had it, as I said, you thought inflation was at 7%, interest rates were high and never coming down. People were worried about the economy, UK and US, and stock markets were very low, and bond markets had sold off as well. We'd had interest rates going up to the highest levels for nearly a generation, and it was causing investors to be concerned. And we were saying to people at the time, just be patient, because looking forward, bond returns from here look attractive, equity markets look cheap. Just be patient. Markets always recover. They have done through COVID, through wars, through bubbles, through financial crises. Markets always recover. You just need to be a little bit patient. And then you forward a year and you look at the returns that have been delivered from portfolios, like I touched on. Bond markets are up nearly 10%. Equity markets are up 24% over the last year. And if people had been patient and they've been rewarded for it last year, I think, just kind of say, most portfolios that we've got are up anywhere between 10 to 20% over the last year, because it was the low in markets nearly exactly a year ago.
Yeah, good. Well, Alex, thank you again for your time, as always. I hope everyone found that useful and beneficial. Thank you for dialing in. The next quarterly investment seminar will be in January 2025. It seems too early to wish everyone a Merry Christmas. However, I look forward to seeing you all in the new year. If there is anything that anyone would like to discuss or like us to cover in future webinars, please feel free to relay that back via your advisor or directly to myself, and we will assist and answer any questions where possible. I hope you all have a great winter, Christmas, and I'll see you all in the new year, if not before. Thank you.
Thanks, everyone. Thanks, Stuart, for today.